John.
I love it. All right. Well, welcome to today's Monday morning mortgage update live from Milwaukee, Wisconsin. I am going to now just jump in and start and share my screen. So bear with me real fast while I go ahead and get this going. So first off, I just want to say thank you for being here on a Monday morning. I know it can be busy. Mondays are usually the busiest for our team as well. So let's just get into it. Let's see. Why is this not going? There we go. So 9/11, guys, don't forget today is 9/11. It's the 22 reunion of that unforgettable morning. So be just in your prayers for the families that are still affected by that. I want to point out who Sandy Richards is on my team. Sandy, hello, she's on here. If you want to pipe in and unmute yourself and say hello, go for it. But I wanted to kind of give you a little insight into some of the members of my team. So Sandy Richards is like, she's my behind the scenes rock star that you guys may not speak with a ton, but you probably do. She handles a lot of the heavy lifting on the pre-qualification and the management of the pipeline. So Sandy Richards, she is on my team. Sandy, say hi if you are on the call. I know you are, so say hi.
Yeah. Good morning.
Good morning, Sandy.
I will.
Yeah, so Sandy has been in the business over 25 years. Sandy, I don't even know how many years it actually has been, but it's been a while, and you've owned your own company in the mortgage industry. You've done a lot, but I just want to say thank you for being part of my team. You make me look like a rock star, and you make my world go round. So thank you so much for everything you do. I just wanted to point out, if you haven't met Sandy Richards, she's amazing, and she is one of the reasons why we do so well as a team. So thank you, Sandy, for everything.
Oh, thank you, Sean. Very, very kind words.
Oh, you're very welcome. So let's jump into rates right now. So here's what's happening with the bond market right now. And I'm going to go into a little bit of the reasons why in a second. Last week, and I want to show you these green bars going down here on this. This shows a very, very strong trend line of going in between this kind of ridge downward. And it's a very strong trend line. So we're going to need some pretty significant data in order for us to push us out of this trend line. We bounce up against it and we come back below it, bounce up against, come below it, and bounce up and bounce back. And last week we had a pretty bad 3 or 4 days. We tried to break through it, but then it just reversed course and kept into this range. So today we've opened down 14 basis points. So rates are going to be slightly worse by the end of the day today. But this trend line is, it's not something that I like to look at. Because this means that the odds of rates getting worse are higher than of them getting better. Now, there are times where we can lock in, like when the bonds are at the highest, and then they came back down, and we lost a lot. There are points where it's important for me to still watch kind of when to lock in. So we locked in most of our people that were floating when the bonds had a rally, and then we lost a little bit. So that's how I gauge when to lock, is by what this bond market is doing. If we're on the way down, like right here, we wait for that trend line and then we bounce back. So I can kind of know what's going to happen with mortgage rates when people call me. So that's a little bit what's happening with rates right now. Here's an overview of where rates are at. This is a national average. This takes into account all rates being locked with and without points. So this is not what exactly your customers are going to get with no points. A lot goes into rates, but this just gives you an idea where we're at. So as an example, if you have a 750 or 760 credit score, you may get a really good rate. But if you have a 640 on a conventional, you may get a rate in the 8s. So there's a lot of loan level adjustments that come into play, but this just gives you a gauge of where we're at right now. Just as a good rule of thumb, 30-year average 7.22, 15-year 6.59, 30-year jumbo, we're in the low sevens as well. ARMs are about the same. We have that inverted yield curve, and then FHA is just slightly below 7 here for that in VA. So the magic question, or the question everyone is asking is, when are rates going to be below 6%? When are they going to get down, right? Well, I want to urge you guys, to anyone that's on the fence, to ask them just this simple question. If you can get a mortgage rate in the 5s, would you buy a home now? If they say yes, then we need to find a home that's been on the market a little bit that's going to allow a seller buy down so that we can offer them this option. So they are still working, guys. These rate buy downs are working. It's harder now because there's not as much inventory to have a seller that's willing to do it. But we need to at least open this conversation. And if your buyers are adamant about waiting, then just get them ready because it's going to be crazy when rates do hit the fives. So when will this happen? When will rates drop? The answer, later than expected. I'm going to go into that in just a second here as to why I believe rates are going to be lower, but we have some headwinds. We've got a tug of war, and I'm going to go over that in just a second. So this is the activity for last week. There was a deluge. When I say deluge of debts, it was a deluge that's coming on. That's we're going to be selling bonds, issuing debt of $210 billion this week. So we're going to be issuing and selling off $210 billion in treasuries this week. That's 210,000 stacks of $1 million stacks. That's how, that's to put it in perspective. 210,000 piles of $1 million. That's what we're going to be raising and selling in bonds. So remember, mortgages are bonds. So if there's a lot of one thing in the market, if there's 100,000 homes in the market right now in Maricopa County, what does that do for values? It makes them come down. It's the same thing with bonds. If there's an overindulgence of bonds in the market or treasuries, it makes them worth less because not as many people want to buy them. So there was a huge deluge of corporate bonds, and then this week there's going to be a huge influx in government bonds. So another thing coming up, and the reason I'm going over this bond market stuff is I'll explain it when I'm done. But we have $7.6 trillion of U.S. government debt that's scheduled to mature next year. So they've got a treasury where they owe money back to people after it's matured. That money is going to be going back, and that has to be resold. So that's another group of a lot of bonds that's going to be hitting the market. So in a nutshell, because of all of the influx of treasuries and of bonds being sold, it's a tug of war with the mortgage rates. With inflation coming down and with the recessionary news of unemployment going higher, that should bring mortgage rates down, but this bond activity is actually keeping them high. So last week, we did not see any rate improvement, slightly on Friday, but overall last week we were higher in rate because of this. So this is where it's not fun when you're trying to when your hope and your dreams are for lower mortgage rates. When you see the bond selling kind of counteracting where we're at. Hold on one second. Why isn't it going? So lower rates are going to be when this formula hits. Higher unemployment, lower inflation numbers, and fewer treasury bond auctions. That's when we're going to see lower mortgage rates. I'm predicting in March that it's going to be better. And that's when that buying season is going to be here. And with a little bit lower rates, hopefully we'll see all those people jump back off the fence. But this is what it's going to take. So watch the unemployment numbers. And here's the jobs reports that we had lately, because unemployment is very, very important to the feds. And they're going to be watching this unemployment report very carefully. So hopefully the feds will put a pause, which everyone thinks they will be putting a pause on this next meeting. So we'll know on that on the 20th. But here's something I want to show you. January, they projected that there was 517,000 new jobs. Okay. Then they revised it after the numbers came in, and it was 504,000. And then when they really revised it again, it was only 472,000. So the jobs numbers that they're coming out with have been inflated dramatically every time they come out. So it's really interesting. So February, they said there was 311. There ended up being 248,000. March, they said there was 236. There was only 217. Notice how the job numbers are going lower and lower and lower as we move on. This is a sign of a recession. This is a sign of tightening. This is a sign that what the feds are doing is working. Hopefully they'll look at this and they'll say, okay, it's time to pause because we are seeing it actually affecting the jobs report finally. But these revisions are drastic. The problem is when you have a good jobs numbers report, it affects mortgage rates poorly. But then when there's a revision, that's never taken into consideration in the mortgage rates. So It's kind of a bummer that they're so wrong all the time when they initially bring out the jobs numbers, but that's where we're at. That trend line, though, of showing less and less jobs per month is actually really good for this market. We want the market to slow down so inflation comes down. So we are on the right course, guys. We are a few months, maybe 6 is what I'm guessing, away from, I think, a good trend line where the bond market recovers and we're seeing better rates. But I want to show you something. If you've heard anything out there right now as far as unemployment, I want to show you what happens. These are the employment numbers, the unemployment rate. It's always low right before a recession. So unemployment is always low before a recession. So if you look all the way back here, unemployment was low. During the recession is when it spiked, right? Unemployment low is when the recession started, this gray, and unemployment spiked during a recession. So the Feds are saying it's not a recession because there's low unemployment, but the lowest unemployment rate is typically always where the start of a recession happens. And we saw that low in July. August, unemployment ticked up from 3.5 to 3.8%. So we're at that rise in unemployment, which is a good sign that mortgage rates coming down is in the future. We just have to stop all this bond selling. And this is my illustration of how much they're going to be selling. This is on their website. You can go right into the onto the government website to see what they're auctioning off. So today, the 11th, there is 69 billion of auctions that they're auctioning off right here. Then again, they have a $62 billion auction that's happening. And then if you look on the calendar, they've got 1, 2, 3 that are handling, that are going to be doing the 13th, 14th, and 18th, and the 18th. And again, there's another auction tomorrow. So if you look at all of these auctions, there's 210 billion just in the next 2 days that's going to be auctioned off. So hopefully those go well. If there's an appetite for the bond auctions, rates can improve. But if there's not, because there's just too many out there, we could see mortgage rates deteriorate. Here is the inflation numbers, because remember, inflation is a big piece of this. We did see an uptick last month in the inflation. Gas and services did come in a little high, but the overall trend on inflation is coming downward. So that is a good thing. We want that to continue. So this week we have the CPI, Consumer Price Index, that's going to be coming out. And that's going to be before the Fed's decision. So to raise or not to raise is the question. And we all believe that the Feds will pause this time. So if we can slow down the roll on the bond auctions and the raising capital for the CHIPS bill and the infrastructure bill and all of the spending that we do as a government, if we can slow our roll on that, it will help mortgage rates come down. Here's what's happening this week. Again, CPI, Consumer Price Index, that's coming out Wednesday. That's going to be very, very important. And then we've got these treasury bonds every day this week. It's going to be crazy to watch that. So it will be a very volatile week because of that. We have PPI, Producer Price Index, on Thursday. And we got some import information manufacturing on Friday. So it's going to be a really big week as far as volatility. We hope that these bond auctions don't pull too much back in the opposite direction where rates continue to worsen. So once this spending and these bond auctions are slowing down, once inflation is slowing down, and once unemployment is raising, that's when we're really going to see the mortgage rates improve. But we're still in the 7s, guys, sometimes higher. Let's start with some good news. So over the weekend, you may have heard, let's continue with some better news. Let's just say that. We saw some news this weekend that there's a new ruling on casitas. So the name of this presentation today, or the Monday morning update, was Jobs, Casitas, and Margaritas. So I'm going to go over the casitas part now. Margaritas, I'll talk to you in just a bit. But it is now okay for you to get permits in the Maricopa County to build casitas in your backyards. So really good news if you wanted to do that, and maybe there was some restrictions before, now you can do it. So the problem is that some people will see is you can't rent them out. So if you wanted to build a casita to rent it like for Airbnb, that's not allowed, but you can now do it on any single family residence. And here's some really good information. As far as setbacks go, you have to follow the normal setbacks of the house. So screenshot this or keep this because this is going to be really good information for you to know. It's online as well. But for lots up to 10,000 square feet, you can build a 1,000 square foot casita. For those over 10,000, the maximum size is a 3,000 square foot one, which is very large. But it can't be more than 10% on net of the lot area, whichever is less. So be careful on that. It can't be larger than 75% of the house. But this is a great thing to share with anyone that you have that currently is in a home, and they've decided not to sell, but they wanted the room for maybe an office or for their mother-in-law suite, or for their parents to live in. This is a great idea for them, and we do have these 203K type and home improvement loans that you may be able to use for this. So if anyone's thinking about adding on to their home, getting a casita, whatever it might be, now you can take advantage of that. So it was a nice little ruling we saw. Back to margaritas. So I want to end on a good note. I'm going to do a little happy hour Friday, this Friday, margaritas. The location is still going to be announced, but it's from 4 to 7. We all need to stay positive, and I think hanging out and just trying to bring some positivity to the market right now is a good idea. So this Friday, I'll be hosting a happy hour. It's going to be somewhere in the Phoenix, Scottsdale area on Friday. That's the 15th, this Friday, from 4 to 7 p.m. So put that in your calendar. Expect to get the text alerts and the emails on the location of that for this Friday. So overall, guys, we're going to see mortgage rates, I think, struggle this week with all of the auctions that are going on. And hopefully we'll be able to have a much better couple months as we move forward. But overall, that's where we're at right now. So do you guys have any questions in the chat? Any questions in regards to what's happening in the markets, what to expect, buy downs, any of that? Thank you, Michelle, for the comment on Sandy. Yes, she is the best. It's good to have somebody that is actually smarter than you as your right-hand person. And she is definitely that person. So thanks to Sandy for everything. All right, guys. Well, it's Monday, and let's talk casitas and margaritas. And hopefully those jobs numbers will come in a little bit lower in the near future. And as far as the unemployment going up, let's hope the bond auctions don't really hurt us this week. And let's really keep an eye on that CPI, which is Wednesday, and then the PPI on Thursday. And let's hope for lower rates for the future. But in the meantime, I'm always here for you guys. Enjoy your week, and we will be in touch.